Dear Traders Mastering family, I'm truly sorry for not posting over the past few months. Life got in the way, but I'm back now and more committed than ever. Thank you for your patience and support. It means so much to me. Stay tuned for exciting new strategies and content to help you crush your trading goals in 2025. Let's grow together. Happy trading and God bless. Imagine this. You're staring at your trading screen, waiting for the perfect moment to strike. You've seen the price move against you too many times before, and now you're determined to get it right. Here's the challenge. Most traders struggle with timing their entries and end up chasing the market or getting stopped out too soon. Sound familiar? Well, today I'm going to show you a proven strategy inspired by Larry Williams' techniques. We'll dive into how to use multiple time frames, identify trend changes, and spot the exact moment to enter a trade confidently. This strategy will help you improve your accuracy, maximize your profits, and manage risk like a pro. It's simple, effective, and something you can apply immediately. Stick around because mastering this concept could be the game changer you've been looking for. Let's get started. Welcome to Traders Mastering, where we help you become the best trader you can be. Today, we're diving into Larry Williams' powerful trading strategy. You might be asking, how can I trade more effectively and make consistent profits? Well, you're in the right place because this strategy is all about finding the best moments to enter and exit trades, while managing risk carefully. So, what's the problem many traders face? They often struggle with timing their trades. They buy or sell at the wrong time, causing losses instead of profits. And even when they make the right call, they might not manage their risk properly, leading to big losses. It's like having a good plan but not know when or how to use it. Larry Williams' strategy aims to fix this by teaching you how to identify clear entry points, use multiple time frames to your advantage, and manage your risk effectively. Let's break down the steps of Larry Williams' trading strategy. Step 1. Daily candlesticks and bullish close. The first step is all about looking at the daily candlestick chart. You want to dive into the new daily candlestick and make sure the previous candle closed bullish. What does that mean? A bullish candle means the price went up during the day, and it closed higher than it opened. This shows that the market is in an uptrend. So, before you make any moves, confirm that the market is showing signs of strength. Step 2. Use the 4-hour chart now. You'll move to the 4-hour chart. On this chart, you'll look for something called the previous day's order block. An order block is a price area where big market players like banks and institutions have made large trades. These areas act like support or resistance where price might bounce. So, check the 4-hour chart to spot where the price might change direction based on these key zones. Step 3. Look for the TC change on the 15-minute chart. Once you've identified the order block on the 4-hour chart, you'll move to the 15-minute chart. This is where the magic happens. When the price hits the order block or liquidity zone, you're waiting for a TC change. This is a change in trend or structure on the 15-minute chart. If the structure shifts to bullish and the candle closes in the direction of the new trend, you can enter your trade. This step ensures you're entering the trade at the right moment when the market is ready to move in your favor. Step 4. Risk management. Risk-to-reward ratio. Risk management is key in any trading strategy. Larry Williams recommends a 1-to-3 risk-to-reward ratio. This means that for sellers, by managing your risk carefully, you can stay in the game longer, even if a few trades don't go your way. Step 5. Our time zones. ICT Asian and London kill zones. Lastly, the best times to trade with this strategy are during the ICT Asian and London kill zones. These are the times when the market is most active and you're more likely to see big price movements. Stick to these times for the best results. Let's break down the steps of Larry Williams' trading strategy for bearish setups. Step 1. Daily candlesticks and bearish close. The first step is all about checking the daily candlestick chart. You need to examine the new daily candlestick and confirm that the previous candle closed bearish. What does that mean? A bearish candle indicates that the price went down during the day, closing lower than it opened. This signals that the market is in a downtrend. Before proceeding, ensure the market is showing signs of weakness. Step 2. Use the 4-hour chart. Next, switch to the 4-hour chart. On this time frame, you'll look for the previous day's order block. An order block is a key price area where large institutional traders, banks, funds, have made significant trades. These zones often act as resistance, where the price is likely to reverse or reject. By identifying these order blocks, you can anticipate where the market might change direction. Step 3. Look for the TC change on the 15-minute chart. Once the order block or liquidity zone is identified on the 4-hour chart, move to the 15-minute chart. This is where you'll look for a trend change, TC. When the price hits the order block or resistance zone, you wait for a bearish TC. This is when the trend shifts from bullish, higher highs and higher lows, to bearish, lower highs and lower lows. You'll confirm the trend change by observing a bearish candlestick close that aligns with the new downward trend. This step ensures that you enter the trade at the precise moment the market is ready to move down. Step 4. Risk management, risk-to-reward ratio. Managing risk is essential in any trading strategy. Larry Williams emphasizes a 1-to-3 risk-to-reward ratio, meaning for every dollar you risk, you aim to make $3. For instance, if your stop loss is 20 pips, your take profit should be 60 pips. This ensures that even if you lose some trades, your wins outweigh the losses. Step 5. Focus on key time zones. The best times to trade with this strategy are during the ICT Asian Kill Zone and the London Kill Zone. These are periods of high market activity and volatility, increasing the likelihood of significant price movements. Sticking to these time zones can help you capture better opportunities for bearish setups. Sure, on how the bullish strategy would work on the US dollar to Canadian dollar pair using the example from January 9th, with a trend change, TC, occurring between 2 a.m. and 3 a.m. New York session. Step-by-step breakdown. Step 1. Daily candlestick and bullish close. On January 9th, first, we look at the daily candlestick chart for US dollar to Canadian dollar. You need to check the previous day's candle, January 9th. If the candle closed bullish, it means the market had an upward movement, and the sentiment was positive, signaling potential for a continuation or a new bullish trend. If the previous day's candle is bullish, it confirms that the market is showing signs of strength, so you are on the lookout for bullish setups. Step 2. 4-hour chart and order block. Next, move to the 4-hour chart. Look for an order block or a liquidity zone. These are price areas where institutional traders are likely to have placed large orders, and they often act as strong support or resistance levels. For this example, let's assume that the price is approaching a previous day's order block, for instance, around a support zone or a key level where price had reversed previously. This is where the market might change direction or show signs of a reversal. Step 3. Look for trend change, TC, on the 15-minute chart. Now, focus on the 15-minute chart for a trend change, TC. This is the most critical part of the strategy. From 2 a.m. to 3 a.m. during the New York session, you're watching for a trend change. If the price approaches the order block or liquidity zone and shows signs of a bullish reversal, that's your signal. A trend change, TC, occurs when the market shifts from a bearish trend to a bullish trend. This is typically marked by a shift in structure, lower lows and lower highs turning into higher highs and higher lows, hits the order block or liquidity zone. In this case, between 2 a.m. and 3 a.m., the price hits a key level, like an order block, and the 15-minute chart structure shifts to bullish. You start seeing higher lows and higher highs, confirming that the market is changing direction. Step 4 and Step 5. Risk management and time zones. Once the trend change, TC, is confirmed on the 15-minute chart, you can enter the trade, as the market is now showing a bullish structure. Risk management. Use a 1-to-3 risk-to-reward ratio. For example, if your stop loss is 10 pips, you aim to make 30 pips. This ensures you're not risking too much on a single trade and helps manage potential losses effectively. Time zones. Since this occurred between 2 a.m. and 3 a.m. during the New York session, it's a prime time for market movement. The New York session often sees significant volatility and price action, making it an ideal time to trade with this strategy. Example of the trade. Let's say that around 2:15 a.m., The price of US dollar to Canadian dollar is approaching an order block from the previous day. You observe that the price action starts to shift. A bullish engulfing candle forms on the 15-minute chart, signaling the start of a new bullish trend. The structure changes, and now we have a series of higher lows and higher highs, confirming that the trend is turning bullish. At this point, you enter a buy trade with a stop loss just below the most recent swing low and a take profit at a level 3 times the risk, following the 1-to-3 risk-to-reward ratio. Let's walk through the bearish setup on the GEP-CAD pair that occurred between 2 a.m. and 3 a.m. on January 2nd, using the Larry Williams strategy for a trend change, TC. Step-by-step breakdown. Step 1. Daily candlestick and bearish close. First, check the daily candlestick for January 2nd. You'll want to confirm the previous day's candle, January 1st. If the candle closed bearish, it means the market was showing downward momentum, and there's a higher likelihood of the trend continuing lower. A bearish close indicates that the price was driven down during the previous day, signaling a potential continuation or a setup for further bearish movement. Step 2. 4-hour chart and order block. Next, switch to the 4-hour chart. Here, you'll look for an order block or liquidity zone, which is an area where institutional traders may have placed large orders. This can act as resistance where the price may struggle to go higher, potentially reversing. In this case, let's assume there is an order block on the 4-hour chart at a key resistance level, possibly from a previous rally. The price could be approaching this level during the early hours of January 2nd. Step 3. Look for trend change, TC, on the 15-minute chart. TC, on the 15-minute chart. Now, focus on the 15-minute chart for a trend change, TC. The goal here is to identify when the market shifts from bullish to bearish. Between 2 a.m. and 3 a.m. on January 2nd, you'll watch for the price to reach the order block, resistance zone. If the price starts showing signs of rejection at this level, you could expect a bearish reversal. A trend change, TC, occurs when the market shifts from higher highs and higher lows, bullish, to lower highs and lower lows, bearish. On the 15-minute chart, this could look like a reversal candle forming at the resistance level, e.g., a bearish engulfing or shooting star candle. A shift in structure, where the market stops making higher highs and starts forming lower highs. At this point, you can enter a short, sell, trade once the price shows a clear bearish structure shift on the 15-minute chart. Risk management and time zones. Risk management. As part of the strategy, use a 1-to-3 risk-to-reward ratio. For example, if your stop loss is set at 15 pips above the resistance level, order block, your target profit would be 45 pips lower, ensuring that the potential reward outweighs the risk. Time zones. The 2 a.m. to 3 a.m. New York session is an ideal time to execute this trade because the market tends to show more movement and volatility during the New York session. This helps to confirm that the market is actively making moves in your favor. Example of the trade. Let's say that around 2:15 a.m. on January 2nd, the price of GEP-CAD approaches a previous resistance level, order block. On the 15-minute chart, you notice a bearish engulfing candle or a shooting star forming at this resistance level. This indicates that the price is likely to reverse, and the trend is changing from bullish to bearish. The structure shifts. Instead of higher highs and higher lows, the price begins to make lower highs and lower lows. You enter the sell trade after confirming the trend change, TC, on the 15-minute chart. You set your stop loss just above the recent swing high and your take profit at a level that offers a 1-to-3 risk-to-reward ratio. So, how does this strategy help traders improve their results? By following Larry Williams' strategy, you'll improve your timing. You won't just guess when to enter the market. You'll know exactly when to make your move. The use of multiple time frames, daily, 4-hour, and 15-minute charts, gives you a clear view of the market's direction, which leads to more accurate entries. And with a solid risk-to-reward ratio, you'll manage your losses while maximizing your profits. By staying disciplined and sticking to the strategy, you'll see better risk management and more profitable outcomes over time. It's about waiting for the right opportunities and trading smartly. Trading is not just about knowing the strategy, it's about being disciplined and patient. Larry Williams' strategy teaches us the importance of sticking to the plan and waiting for the right signals. The market can be unpredictable, but by following a proven method, you can stay focused and consistent. Remember, it's easy to get distracted by all the noise in the market, but having a clear strategy helps you filter out the distractions and make decisions based on logic, not emotions. Patience is key. Wait for the perfect setup, follow the rules, and trust the process. Over time, this method will help you become a more disciplined and successful trader. If you enjoyed this, don't forget to like and subscribe to Traders Mastering. In my next video, I will share with you one of the most profitable strategies using this concept, scalping or day trading. Happy trading, and God bless.